Friends, I, Captain Vivek Jain, welcome you all to my 14th episode. In my earlier episodes, we have learned about most of the important and popular financial ratios of a public limited company, such as EPS, earning per share, PE ratio, book value, price to book value, dividend yield, gross profit and net profit margins, return on assets, return on equity, return on capital employed, debt equity ratio, interest coverage, current and quick ratios, dividend payout ratio. Friends, with the study of above that we have learned and understood, coupled up with the study of a company's balance sheet, profit and loss account, one can comprehend a good idea and perspective of its fundamentals, and that is generally known as the fundamental analysis of a company. This analysis is more so understood clearly when we compare the corresponding figures of so many parameters of various companies side by side, and that gives us a relative picture of fundamentals. So friends, today we shall actually study the figures of financial ratios of few blue chip companies. Friends, I have chosen three companies at random, each market leader in its own industry. I've chosen pharmaceutical company, an information technology company, and a fast moving consumer good. First, as you see on the screen, are the key financial ratios of leading pharma company, Dr. Reddy Laboratories Limited. We will see all the various ratios of this company and learn about it. The equity capital of Dr. Reddy Laboratories is 83 crores. Face value of each share is 5 rupees. I have the data here for the past 3 years, 31st March 2018, 31st March 2019, and 31st March 2020. You can see that the EPS has been increasing quite appreciatively from 57 to 118 to 122. The book value of the share has also been quite handsomely increasing from 711 till it comes to 914. The dividend that the company announced and declared and distributed to the shareholders is 20, 20 and 25 per share. That means on a 5 rupee share, if you distribute 20 rupees, it makes it 400%. And in March 20, when it distributed 25 rupees, it means 500% of the face value. The various parameters are mentioned over here, which, as you will be observing over the years of various companies in a regular manner, you will get accustomed to it, you will get acclimatized to it, and you will be able to decipher them, compare them between companies, and it will give you a very clear picture. Net profit per share is the same thing as earning per share, which is repeated over here. There is a mistake over here. It is actually 57, 118, and 122. So we'll disregard that particular row. Profitability ratios. You have the first one is profit before depreciation and tax. The net profit margin is what the investors are mainly interested in, which is after all the expenses are deducted from the gross profit. And this is also working out to quite handsomely. From 6% comes to 12%, and then in March 31st March 2020 ending, it is 24.8%. That means the company has progressed and improved upon its net profit margin over the 3 years. Return on net worth or return on equity is given over here, as you can see. Return on capital employed is also actually a more important ratio because it also takes into account any loans or any other working capital that the company employs for its usage. And this ratio is considered by the analysts as a very important one. And it is ranging from 6%, increasing to 13, and finally coming to 18.5%. Return on assets, 3%, 7.9%, and 15.1%. Total debt equity ratio, it means that whatever is the equity capital plus reserves of the company, how much debt the company has taken against it. I may have probably discussed in my episodes earlier, the financial analysts normally don't like the company to take any debt. Company which is not taking debt is considered to be very good. However, every company does require some working capital, maybe some short-term loan, maybe some loan to tide over for a certain extra expense. So a debt equity to some measure is normally quite acceptable. 0.50 is considered to be a benchmark for analysts that a company should keep its debt equity ratio within 0.50. That means whatever is the share capital plus reserves, half of that, if is taken at debt, that is considered to be a reasonable amount of debt. Maximum it can go up to, or analysts would say, a company can keep its debt equity ratio at 1:1. That means whatever is the share capital plus reserves, that much of debt if a company possibly takes for its various expenses, it is also considered to be okay. However, Dr. Reddy's, you can see the debt equity ratio is far too less. It is almost negligible, from 0.22 to 0.07 only. 0.07 means only 7% of the shareholders' equity, so to speak, has been taken as debt. Current ratio is, as you must be knowing, total assets divided by total liabilities. And this should be more than 1. 1.5 to 1.75 is considered to be a benchmark. However, Dr. Reddy's current ratio is far better than that. From 1.91, it increases and it is between 2.5 to 2.9, as you can see here. Quick ratio is a bit more stringent, in which so many a few aspects which are not easily encashable are also removed from the current ratio, such as inventories. Sometimes companies, they manufacture and they produce goods, and a part of those goods is kept in the stores as inventory. Now, in case the company is going to encash all its assets, and let's assume that the inventory is not easily encashable, so that is probably removed, and then whatever is remaining in the current assets becomes encashable current assets, so to speak, you see. And that, when divided by liabilities, gives you a quick ratio, which normally benchmark is it should be between 1 to 1.5. However, here also this company, Dr. Reddy Laboratories, is far ahead. Starting from 1.52 in March 17, it has improved on to between 2 to 2.25 in March 18 and March 19. Dividend payout ratio from the net profit, as we have discussed earlier, the entire net profit is not distributed as dividend. A part is distributed and a major portion is kept for plowing back in the company so that it can be used for the growth of the company and many other expenses without having to take any loan from anywhere. So the benchmark for dividend payout ratio also, as per the analysts, is ranging between 25 to 33% for the company. Here, Dr. Reddy, initially in March 17, probably when the profits were less, it gave out 70%, and then it came down to 26%, and finally in March 20, when the profits were even better, 14%, and yet 25 rupees per share, as you have seen, the dividend was given. So dividend payout ratio is very good, very handsome, very uh, acceptable, and the retention ratio also is giving Dr. Reddy a lot of cash which it can use for its growth. Market capitalization, this means whatever the market price of the share is, that when multiplied by number of equity share capital gives you the market capitalization, which is ranging between 34,000 and ending at 48,000 on 31st March 2020. Price to book value. Price to book value is, the book value is more or less like a net asset value of a company. It is a shareholders' equity, so to speak, and the price normally have a relationship with the book value. As a benchmark, it should be between 2 to 5. If it is less than 2, that means the reason has to be found out why the market price is so less. And if it is much high and if it is more than 5, then also the reasons have to be found out. But the benchmark is between 2 to 5. Dr. Reddy is between 2.9 to 3.6 over here. Dividend yield, depending upon the market price, whatever dividend has been given, benchmark here is 1 to 1.5 to 2%. Sometimes even less than 1, sometimes more than 2.5 or 3. But average is 1 to 1.5. So here the yield is almost nearly 1% for Dr. Reddy. Friends, we now come to the second company, which is a market leader in information technology, Infosys. As you can see on the screen, the equity capital is 2,150 crores. Face value is 5 rupees. Infosys had given a bonus of 1:1 in year ending 31st March 2019. Bonus, as you may be knowing, means for every share held by any shareholder, one share is given as bonus. If one is holding 100 shares, he gets 100 shares as bonus free, and then he is the owner of 200 equity shares. So from March 18 to March 19 with the bonus, the equity capital of the company has doubled. And that is the reason you can see on the screen here that the earning per share has decreased substantially between March 18 and 31st March 19, because the net profit increases slightly, maybe the same or maybe increases slightly, but with the equity capital doubling, the EPS reduces. Please take that into account. And then you can see I have the data for 5 years here, ending 31st March 2016 to ending 31st March 2020. The EPS has been increasing gradually, and then after taking a dip due to bonus, again on 31st March 20, it increased slightly and ended at 36 rupees 34 paise. Book value per share also increased from 266 to 290 or 291, and then after the bonus, book value becomes half because it was 1:1 bonus, and book value again came down, and in March 20 it settled at 146 rupees. Dividend per share in March 16 was 24 rupees per share. That makes it nearly 500%, 5 rupees face value. March 17 is increased to 25 rupees. March 18 it was increased substantially to 43 rupees. And then with the doubling of the equity capital due to bonus, it was 21 rupees in March 19 and 17.5 in March 20. Net profit margin, you can see over here also, is quite handsome, ranging between 23% to nearly 20%. throughout. Return on capital employed is also very good, in fact, starting from 20.75 in March 16 ending, it came up till 31%. In fact, for the last 3 years, it maintained a ROCE of nearly 31%. Return on assets also from 17 to 19%. Infosys has got a very special debt equity all along. It is always normally zero, I have seen so far. That means this company does not take any loan whatsoever. It generates cash from its own operations, and with that cash, it runs the company. So there is no interest outflow at all. Current ratio is also very good. Quick ratio and current ratio is same because Infosys doesn't have any assets which are not encashable. There is no question of any inventory. As such, both the ratios are similar. Dividend payout ratio is starting from 43, it came up to 46 in 2018, and then because of the doubling of the share capital, it had to increase it to 93%, where the dividend also was substantially raised to 21.5. That makes it 43 rupees on the earlier capital. And then that 93 came down to 61% with the profit increasing in the next year. For information technology companies, the dividend payout ratio is normally 50% and above because they don't need that much of capital to be retained. Most of the information technology companies are, as it is, quite cash rich. Market capitalization is very good in case of Infosys, as you can see here. Price to book value ratio is all along ranging between 3.5 to 4.5. In between, it went up to 5. And dividend yield is quite handsome, in fact, compared to many other companies, ranging between 2 to 4%. And 31st March 2020, it ended at 2.7%. We come to the third company. This is the market leader in fast moving consumer goods section, FMCG as we call it. And it's a very popularly well known company, Britannia Industries. The face value is rupees 2. Equity capital is only 24 crores. Here also you can see that in March 2019, 31st March ending year, the face value of the company, which was rupees 2 earlier, was split and it converted into 1 rupee face value. That means if one owned 100 shares of 2 rupee face value earlier, it became 200 shares of 1 rupee face value. Here it is just splitting, does not give any extra shares like in a bonus. Splitting only dilutes the shares so that more number of shares are held by a shareholder. It has got its own purpose, which we will be discussing later on. EPS, as you can see, after March 16, 62 rupees increased quite gradually, quite well, in fact, 70 rupees and then 79 rupees March 18. And then because of the split, that 79 or 80 becomes 40. In fact, that 40 became 46.71 in March 19. And it further increased up to 61 in March 20. If you see between March 16 and March 20, the EPS is more or less the same, and the share has been split. That means whatever number of shares a shareholder was holding on 31st March 2016 has doubled, and yet the EPS remained the same. In other words, the net profit has doubled in 4 years between March 16 and March 20. See, book value started from 141, came up to 269. After splitting, it became 168 and 178, which is also quite well. If you double 177, it becomes 354. In other words, the book value from 141 increased up to 354 on the same 2 rupee face value share. Dividend is quite handsome. For a 2 rupee face value share, the dividend paid by Britannia Industries ranging between 20 rupees to 35 rupees, which is extremely good and very handsome dividend. Net profit margins, you can see starting from 9.4 goes up to 13.5. It's for a biscuit industry, for a fast moving consumer good with a lot of competition. Margins are not that high. 13.5 is an extremely good figure. Return on capital employed gives the picture much more vividly. You can see from it's ranging from 43%, and yes, the company has maintained it even after splitting 42% and then 39% in March 20. Return on assets also is nearly 20-21% all along. Debt equity over here also is practically zero all along. Only in the final financial year of 31st March 2020, it had to probably take some loan, maybe due to usage of working capital or any other reason. Current ratio and quick ratios are also very handsome, very good, very acceptable. Dividend payout ratio, absolutely like a benchmark between 32% to 28%, and the earnings retention ratio 68% to 71%. Market capitalization is also very good. It's a large cap, more than 10,000 crores, ranging between 32 to 60,000 crores. Price to book value in this case is high, 18 to 15, but then all fast moving consumer good companies, they always have a very high price to book value ratio because the market, the demand for the shares are quite high, and the price also appreciates quite rapidly, and higher price, and naturally the price book value ratio will be high. For an FMCG, this figure, what you see on the screen, is quite acceptable. Dividend yield, you can see the company has maintained nearly 0.7 to 1%. In fact, it is 1.4% in the final year. And to maintain this kind of a dividend yield, I earlier discussed in one of the episodes also, the company has increased the dividend payable per share in a manner that in tandem with the price that is prevailing in the market, the yield that a shareholder gets is not very low. It is a very, very good and very handsome yield. We will be talking about the relationship between dividend yield and compounding effect of holding a share for a long term, and how dividend yield, if it is maintained by the company at a certain percentage, then over the years, after 10 years, 15 years, or 20 years, how much dividend possibly a shareholder will be getting in relation to the original investment. So these are the three companies. I have shown you the various financial ratios. These are easily obtained from the websites, various sources, companies' AGM reports. You can also visit companies' individual website, and you can get the AGM report of any year for past 7, 8, 10 years. The AGM reports are mentioned in the company's website. And from those reports, you can extract all kind of financial parameters, the balance sheet, the profit and loss account, and all these kind of ratios. The study of them, I would again implore that you must get practiced upon it. You must get accustomed to it. You must see that it comes readily to your mind. It gives you a clear and a vivid picture of a company's financial strength. And once you see various companies, various figures, and you accustom yourself in understanding and comprehending these figures, it will be much easier to judge whether I am interested in this business or not, whether I should buy the equity share of this company or not, so that I can also participate in the company's business. So friends, I'm sure you must have enjoyed the financial ratios explained. Now you must also browse, as I just said, through all available resources and study the ratios of other companies in which you may be interested in. That will provide you with a good perspective of such figures to understand and absorb them readily. A good comprehension will allow you that much easily to be able to discriminate amongst the quality of various companies. Because do remember, friends, When your hard-earned money is at stake, you, and I repeat, only you have to decide which business venture to embark. And isn't it so exciting? Get into a business only by purchasing the equity shares. Sit back, enjoy, watch, monitor, and with due patience reap the benefits. And all that without creating any other infrastructure. Friends, in our next discussion, I shall explain the analysis of balance sheet of your companies. Till then, let me remind you yet again to please subscribe to this channel in case you have not done so. Do not forget to post your comments and queries, if any, in the space provided. I shall indeed try and reply to all of them. It gives me a lots of encouragement when your comments do come in. Friends, see you again soon and have a nice day.